I am so excited to talk to you today about something that has only happened one time in my life. But it hasn't just happened for me, it's happening for all of us. This is literally one of the best opportunities that I think I've ever seen. And here's why. There's no risk to it. Think about this. An investment opportunity, a strategy that has no risk, but really good returns. I haven't ever been able to say that. I've been able to talk about the specially designed whole life plans, and I've been able to talk about, different opportunities over on this side, but the whole life policies are guaranteed. But then when you move the money and you lend it out or you buy stocks or you do something, usually there's some risk. This, for the first time ever, because of unprecedented action by the Fed, Mr. Jerome Powell has said it. Well, inflation isn't quite where I want it, so we're going to still push and watch very carefully. In other words, he's saying we're probably going to raise rates again. So what is that going to mean? Well, yeah, that means your credit cards cost more. That means your car loans cost more. Your mortgages cost more. But if you're looking at what I'm going to show you next, you're thinking, oh, Jerome, buddy, pal, thanks, man. I've been waiting for this. My name's Chris Naugle. This is What Now? What's next? You're going to find out. All right, so hopefully I piqued your interest a little bit because the words guaranteed and no risk should really be important today because there's risk everywhere. The markets are at all-time highs. They've been coming off of their highs. The Fed said that we're going to keep pushing. The Fed knows that the number one reason why the economy is still moving in the wrong direction, according to the Fed, is unemployment numbers are historically low. So if you were Jerome or the Fed, what would you be targeting? Companies and employment. But that's already going to take care of itself. They've already laid the foundation. And how? They've raised rates. How many times? A bunch. We went from close to 0 to over 5, and we're probably going to go north from here. Probably one more rate increase. That's my speculation. That's my guess. But if they raise rates one more time, what I'm going to show you next, this strategy, this combo strategy, will be unbelievably better than what we're going to give you today, because I can only show you what it is today. And here's the thing, never have I been able to talk about this. I've never been able to show this strategy. I've talked about them independently, but I've never been able to bring them together in one cohesive package to show you how infinite banking and treasury bonds issued by the United States of America with the full faith and credit of the US. I've never been able to show the two working in tandem as a strategy until now. So before we get into this, I got a favor because you're gonna want what I'm about to show you, and I need something from you. I need you to hook me up by subscribing. I know you thought I was gonna ask for some cash or, well, hey, if any of you wanna mail some cash, I'll give you my address in a private DM. But yeah, you're probably not gonna do that. So why don't you just subscribe to this channel and right up top, smash that, what is it, a bell, an alert, whatever you want to call it, smash the bell, and then give it a nice left, right. Ooh. Sorry. Yeah, man, that right hook's getting pretty good, huh? I've been practicing a little bit, I've been watching some old Tyson and some Rocky Balboa. Anyway, let's get back into it. So what are we talking about here? We're talking about you changing one thing first. So if you're going to invest money, think about this. Where does your investable dollars go? Well, most of you are like, well, Chris, they're in a bank account. Great. How's that working out for you? And right now you're probably saying, well, it's working good, man. The banks are paying me like 2 or 3%. Maybe some of you are getting 5% on your bank. But what happens when the money in the bank that's earning 5% goes out of the bank and goes into an investment like a treasury bond purchase? Does the bank keep paying you interest? No, that's silly. Started with money in the bank, they were paying me interest, took money out of the bank, put it into these treasury bonds, the bank no longer pays me interest, but the treasury bonds are. But what if, by changing one thing, and that is where the money initially goes, it doesn't go into a traditional bank, it goes into your own private banking system. It goes into a specially designed and engineered whole life insurance policy. That's right. I'll cover that in a little bit, but we're not going to go deep into it. I got hundreds of videos that teach you all about these policies. And at the end, I'll give you a really good one, how to design an IBC policy updated to show you exactly what I mean. But if we change where our money goes first, and it goes into a specially designed whole life, as soon as the policy is issued and funded, we have the ability to take loans from that policy. Now hear me out. Let me just explain this really quick. I want you to think of a circle, okay? That's all I want you to do. Your money is on the left side of the circle. The opportunity we're going to talk about is on the right, which is treasury bonds, okay? How much are treasury bonds paying right now? Have any of you looked? Remember, treasury bonds are bonds issued by the United States of America, okay? They have the full faith and credit of the USA. Think about that. They're not going to default on bonds. So U.S. Treasury bonds, right now, if we average them out, if we go from the lowest duration like T-bills up to a 30-year bond, and I'll show you what I did in a second, you're 5.24%. And that is the effective yield as of now, and that is guaranteed. But there's a silver lining, because if you buy the longer duration treasury bonds, anything from 2 to 10 to 30-year treasuries, you don't have to hold them 2 years, 10 years, or 30 years. But if you buy them, the price is like Walmart's rollback on steroids. Because of interest rates going up, the price of those bonds has been rolled back and rolled back and rolled back and rolled back. Hence why Silicon Valley Bank, Republic Bank, and all those other banks that were in trouble, that's why they got in trouble. They had a run on the bank. They needed liquidity. Banks don't have liquidity. I'm sorry if you didn't know that. You know, the vault, the bank that you go to, there's no money in it. Don't tell them I told you that, but there's nothing in there. And then the Brinks trucks roll up when there's a big run on the bank and they bring those big bags. It's all a show. It's like freaking movie land. They got the bags, so it gives you the security, the sense of security that there's gonna be actually money in the vault to pay you your money. There ain't no money. Sorry, there isn't. That's not the way they work. They keep 10% in reserves, usually between BOLI policies, which is bank-owned life insurance, and treasury bonds. But when they were buying treasury bonds in the heyday when interest rates were low, they basically got slapped because when interest rates went up really quick, the price of the bond went down. Now that hurt the banks and that hurt anybody holding treasury bonds from back then. But for you, man, that's one of the greatest buying opportunities ever. You can buy at one of the lowest points in the max history of these bonds that I can see. And I'll show you the chart, the lowest. Warren Buffett says it best, buy low, sell high, and don't lose money. So if we buy now, we are buying close to the bottom. It can go a little lower, but we're pretty close to the bottom. So when you talk about treasury bonds, you talk about risk. What risk comes along with buying treasury bonds or T-bills? 2 risks, time risk and interest rate risk. But the interest rate risk is almost evaporated, right? All the interest rate risk has happened when interest rates are going up, but we're almost at the point where the Fed's probably going to stop raising rates and just let the high interest rates stay for longer, which is already going to do the damage. The damage is already done. The corporate bond cliff, I've done that in another video, is coming. I mean, all of you see that it's slowing the economy down. And because it's slowing the economy down, eventually companies will start to lay people off. They will downsize. And when they downsize, unemployment numbers will go up and the Fed will get what they want. You don't think that's what's gonna happen? I'll bet you $1,000. That's exactly what happens. I just can't tell you when. And then we'll enter a recession, probably next year. Closer to the election would be my best guess, but you can't time the market. And when we enter a recession, what will the Fed do to counteract the recession? Well, if they get their inflation down to their target of 2%, what they would then start doing is they would start lowering interest rates. And remember, I said when interest rates go up, the price of bonds goes down. So what do you think happens when the Fed lowers interest rates to combat a recession? The price of those bonds goes up, and it's Christmas every day that the Fed starts lowering interest rates for anyone that bought treasury bonds like we're going to talk about at that low point. Anyway, let's go back to that one change of where your money went, that circle. We talked about the opportunity being treasury bonds. That's it, but that can be anything. We change where our money goes. We put it into that specially designed whole life. And then what we do is when we fund it, we immediately take a loan from the policy, we move it around the top part of the circle, and we buy treasury bonds. I'm not making an investment recommendation or giving you investment advice. I'm just showing you what I do, and I'm giving you a strategy that could work with you. Consult with your advisors, your CPAs, and your attorneys. There's my disclaimer. This money now went and bought the treasury bonds. Remember with the bank, if you did just what I said, the bank no longer is paying you interest because you took the money out to buy the treasury bonds. But you see, the insurance policy, we didn't take the money out of the insurance policy. Your money's still in the policy, earning interest and dividends on an uninterrupted compounding basis, which means next year you make interest and dividends on the interest and dividends that you earned the prior year. Compounding faster and faster and faster, while the money over here in the treasury bonds is making interest again. But up until just recently, There was always a problem with this strategy. And that problem was the stupid insurance companies. When we take a loan from the policy, even though it's not our money, they give us a loan from their general account and they just subtract it from our death benefit so our money doesn't get affected. We earn the interest on it, but they do charge us interest. Them greedy insurance companies. How much interest do they charge us? It's a little under 5%, but let's round up. Let's call it 5. Okay? So the insurance companies are going to charge us 5% simple interest when our money is sitting in the policy earning uninterrupted compounding interest at a rate higher than the 5%. There isn't a single insurance company that we work with that right now is not paying more than the 5% they charge to use money. So already you're in a good place because you get to make a spread. Because the amount you're earning and the amount you're paying is different in your benefit. Just like the good old banks. What are the banks? You give them your money and they pay you an interest rate. And then when you borrow money to buy the car, the tractor, the trip, the whatever, they charge you more. And what do they make in between? A spread. By you becoming the bank, changing where your money goes first, you get to become the bank. You get to make the spread, but you get to make money twice. Did you follow that? By just changing where your money goes first and applying this process that I'm explaining of taking the loan from the policy, paying the loan interest every single year to the insurance company. Because hey, if the insurance company is going to pay me more than what they charge me, do you have a problem paying the insurance company? No, and you better not, because otherwise, don't even watch the rest of this video. If they charge us 5% and they pay us more than 5%, give them the 5% at the end of the year. But here's the cool part. Even though the insurance company charges us 5%, the bonds right now, if we did a blended return of different duration bonds, which I'll show you on the board in a moment, you're making an average yield of 5.24. You're in the money, baby. You're in the money twice because 5.24 is more than 5. But here's the best part. Let's say you buy those treasury bonds and you get that interest that they pay you, that yield. But instead of taking that interest and yield and leaving it in your brokerage account or leaving it in the bank, somebody else's bank, you take the interest and dividends every time you get it and you put it back into the policy. What you're doing is you're paying the loan down. And by paying the loan down, you're not paying 5% anymore. It's simple interest, folks. Just run a simple interest calculator and then pay it down every single month and every single quarter. What happens is as you pay the loan down and as your money's compounding up, your effective interest rate that you pay the insurance company is lower than 5. And it just goes down and down and down. And it's not even your money paying the interest. It's the treasury bond yield. But that's not why we're buying the treasury bond. We're not buying it for the yield. We're not clipping the yield coupons, okay? The interest coupons, that's what some people used to call it. We're gonna buy bonds and we're just gonna clip the interest on a monthly basis or quarterly basis, and that's what we're gonna live on. No. We're just gonna use the interest on the bonds to basically cover the cost that the insurance company charges us to use money so that the money in our cash value can just grow. But here's why we're gonna buy treasury bonds. This is the best thing and the once in a lifetime maybe opportunity. Remember I told you, when interest rates go up, the price of the bonds come down. Actually, you know what? Hang on a second. Can I just show you this? Let's go over to the board. Let me show you what I'm talking about. Come on. A little excited today because when I actually had the aha moment, this vision came to me. And this is exactly what I'm going to do with money from my policy. So that's why I'm talking about it. And here it is. Look it, you changed one thing, where your savings went first. You put it into a specially designed and engineered whole life, much like the one I have here. Now I have 10 of these, but I'm just gonna talk about just this one today, okay? Because I'm gonna give you real numbers from my real illustration. And we take the money from there and we take a loan from that money. So when we take the loan from the policy, remember, we're not using the money in our policy. So we'll just use 10 grand to keep things simple, right? We're gonna buy 10,000 worth of treasury bonds, okay? So we got 10 grand in the policy and we wanna take a loan. So let's just say we take 10,000 out, which you wouldn't be able to take all of the 10,000, but you could definitely get about 90%, okay? Fair enough? So actually, let's just make this a little bit more just so that I'm not having anybody be like, you can't actually do that. Okay, great. If you got 12,000 that you put in from savings, we had 12 grand in our savings, we put it into the policy. You definitely could take a loan for 10,000 bucks if we design your policy. Now, if one of those other guys or gals, yeah, that person right there, you know, oh, that's your brother-in-law? I freaking knew it. But if your brother-in-law sold you one of these whole lives, it wouldn't work this way. No, but let us do it. This is what we do every day, and this is all we do. So tell your brother-in-law, thanks, but no thanks, buddy. Actually, you know, like you might want to shave. Yeah, get that. All right, anyway. Look who's talking, I need to shave. But here we go, we take the loan from the policy, and right now, the insurance companies we work with which are giant, mutually owned, dividend-paying insurance companies, okay, are about a little under 5%. So I rounded up, and most of the policies that we do right now pay about 5.5%. That's a kind of a roundabout average. You know, we have one that's a little bit less and one that's quite a bit more. So if I just average it out, this is what you're making in interest and dividends. Oh, and by the way, the interest is guaranteed, okay? So we take the loan out, 10 grand, and we buy treasury bonds. Now, let me just give you this. I looked these up today. Today is October 30th, my mom's birthday. Happy birthday, Mom. Love you. See you a little bit later. Anyway, wish my mom happy birthday in the comments right now. She will love it. I'll show it to her. Thanks. Oh yeah, and remember, while you're down making the comment, just hit that subscribe button and click that little bell. Thanks. All right, so here's what I looked up. I looked at different bonds because we don't want to just buy one bond. What we're going to do is we're going to build a portfolio of bonds. It's very simple. You can go to treasurydirect.gov, which is a government website. You can buy the bonds direct. Or you could go in and find some ETFs, like exchange traded funds, that have the durations, and that might be the easiest way to do it. But let's just use a 3-month, a 6-month, a 12-month, a 2-year, a 10-year, and a 30-year treasury bond. Now that's a mix of T-bills and T-bonds. The shorter duration ones, like the 3-month, 6-month, 12-month, those are called treasury bills, or T-bills as they like to call them. The longer duration stuff, 2 years on, are treasury bonds. Now let me give you a little history about treasury bonds. Brandon here in my office came up and he said, he used to run a bank. He said, hey Chris, make sure your audience knows that banks, when they don't have a place to lend the money out, guess where they put their money? Treasury bonds. Why? Because they're guaranteed by the full faith and credit of the United States of America. So if it's good enough for the banks, it's definitely got to be good enough for you. But consult with your CPA, your legal team, maybe your financial advisor, maybe not. But I'm not making financial recommendations or giving you financial advice. I'm just telling you what I'm going to freaking do because this is bad. So if we take all those bonds and I average the rate of return, the yield out, it's coming up to 5.24%. Now, does anyone see where that's an important number? 5.24%. Let me actually come over to this side. 5.24%. I got my little disclaimer that we're using 3-month, 6-month, 12-month, 2-year, 10-year, and 30-year bonds, averaging the yield out, and we get 5.24 as of 10/30 of 2023. So if I bought $10,000 equally of all those different bonds, and I make 5.24, but it only cost me under 5% to use the money, you see what I'm saying? You picking up what I'm putting down? You're making a spread, guys. But I know you're like, oh my God, Chris, are you seriously getting excited about 0.24%? We like to call that 24 basis points. Hell yeah, I'm getting excited. You know why? Yeah. This is the first time. The first time probably in my investing years of living on this earth that I actually could make a spread by using money from my policy to buy guaranteed treasury bonds. This is the first time. First time. So I get to make a spread here, but you see, that's not the first time I made money. Remember, I'm making 5.5 and only paying 5. So I'm actually making 2 spreads. Go call your bank and ask them if they'll pay you a spread twice on the money that you have in the bank when you take the money out. They'll laugh your ass out of the bank. They'll be like, yep, they're getting crazier out there. Yep, see that guy right there? Oh, he's bat crazy. Yep, look at him. Look at him. He just came in here and thought that the bank was going to pay him a spread twice. He thought that we would pay him interest on the money even when he takes it out. Can you believe the nerve of these people? Yeah, well, that's exactly what will happen if you go to a bank, which is why we're not using banks. We're using giant, mutually owned insurance companies and a product that's been around hundreds of years, time-tested, used by banks themselves for their reserve capital and just their lazy cash. Where's that kitty? Kitty, come here, lazy cash. Well, he'll show up a little bit later. But yeah, banks have lazy cash too. They're not a kitty cat, it's just money that they're not using, and they buy treasury bonds. So, again, I'm just trying to help you understand this. But they don't just buy treasury bonds, they buy whole life insurance. Yep, that's what the Rockefellers used. That's what the Rothschilds used. How about the Morgans, the Stanleys, the bankers? Yep, they used whole life too. All of them did. So that's why I'm telling you this. We're able to make 2 spreads. Look at this. We make 0.05% here, okay? That between that, so 50 bips, we'll just do 50 bips, Okay, we make 50 bips there, gross. After cost of insurance, it's not gonna look that way. I'm gonna actually give you the numbers with my policy. And over here, we make this spread. So here's what you do. This is the most important part. If you're going to be the bank, BYOB, if you're gonna be your own bank, what you've gotta do is you've gotta be an honest banker. Because let's be honest, if you actually owned a bank, would you steal from your bank? Come on, be honest with yourself. Look in the mirror right now. Yep, grab a mirror, grab your phone, switch the camera, and just say, I would never steal from myself.
I would never steal from myself.
I know that sounds stupid, but sometimes we gotta check ourselves. Check yourself! You gotta get real with yourself. If you're gonna be a bank, if you wanna mimic a bank, you can't be stealing from your bank. So the best part is I don't want you to have to work harder, work longer, and I definitely don't want you to take on any risk, which is why I'm showing you this. So here's the second piece. The first piece was we changed just where our money went first. But the second piece is probably more important. Remember, the bond portfolio is going to pay you a yield of about 5.24. That's the average yield, okay? Yours might differ. But at 5.24, when you get that interest, when the bonds pay it to your account, what you're going to do is you're going to take that interest right here, the 5.24, and we're going to put it back in the policy. Why put it in somebody else's bank? Why let the brokerage accounts hang on to it? They're just going to take that money, leverage it, and make more, and they're going to make a spread. So we're not going to let them do that. We're going to take the interest every time we get it, and we're going to put it back in our bank. Now, what that's going to be called, and our team will help set all this up, it's going to be called a loan repayment. So we're going to take whatever interest that is. So in this case, let's just call it $524, okay? We'll just do a yearly interest. We're going to take $524 a year, and we're going to put that back in the policy. So every time we put that interest back in, what we're doing is we're reducing the loan. We're reducing the loan interest. Why? Because we're paying the loan down while our money is compounding up. See, the beauty is this is simple. One goes up, your money in your policy goes up, the loan that you took from the insurance company goes down, and we're using money that fell out of thin air. Well, it didn't really, it's the interest, but it's not money you worked for. It's money that your money worked for. You sent your money out to work for you, but you sent it out to work for you in a really safe and cozy place called treasury bonds. See, this is the most important part, and also the part that most people miss, is the recycle and recapture. If you're gonna be a bank, don't let your money leak to somebody else's bank. Don't let your money leak to the brokerage account, which, by the way, is usually a bank too. All right, you guys ready to really see something that's gonna blow your mind? I'm gonna show you something I've never shown before, something that I really never thought about until we started to create the tools, which will be available to everybody soon. I'm gonna show you actual numbers. I'm gonna pull out all the stops. I'm gonna show you my policy, okay, that I would use doing this, and I'm gonna show you being an honest banker, this, repaying your bank back, repaying the loan down, how much that helps you. You're probably just thinking right now, you're stuck on 5% loan interest, 5.24%. You're like, I'm only making 0.24%. You're wrong. Remember, I said the loan balance is going down, which means the effective interest you're paying is also going down. It's no longer 5% that you're actually paying. It's 5% stated interest, but you're not paying that because you're paying 5% on a lower balance, which means your effective interest paid on a simple interest loan is lower and your money is higher. Check this out. All right, I know I'm so excited, but this is like one of those moments, like sometimes when I'm running or when you wake up from a deep sleep with a dream, you got this idea, this happened today, and now you're the first to see it. Here is one of my policies. Now let me give you some basis. I'm 46 years old today, so this policy is 3 years old. Okay, I just want you to know that. I've had this policy 3 years. I started it 8/17/2020. This is my COVID policy. Awesome. The premium is $30,000 a year. So I don't want to get crazy with numbers. I could go a wall of numbers, but let's just look at a couple years. Why just a couple of years? Because if we do this strategy, if we start the policy, take the loan, buy the treasury bond portfolio, and then do the recycle recapture of the interest the bond portfolio produces, we're not going to own these bonds for that long. All we're going to do is wait for the Fed to react to the recession when we're in it. Oh, we will be in a recession. Oh yeah, that's my speculation, but I'm gonna just put that right in, that's gonna happen. So when we're in a recession and things start slowing down, the Fed has always dropped interest rates. I wanted to show this real quick. So here's what I mean. It's an X, right? Interest rates go up, price of bonds goes down. Here we go. Interest rates up, price of bonds have gone down. There's the chart. Check it out right here. Yep, that's the movement of a 20+ year bond ETF called TLT. Not making a recommendation, I own this one. Okay, got that? So that's because the interest rates went up, so the price of the bonds went down. But what happens, it inverts. When interest rates go back down, because they're fighting off a recession, trying to get you to spend more money to come out of a recession, guess what happens? The price goes up, and guess what happens when the price goes up? We sell. Now, I can't tell you when that's gonna be. It might be next year, could be the year after, could be the year after. So I'm only gonna show you a couple years because we're not gonna hold these bonds for a long period of time. We're literally gonna get in and we're gonna get out and we're gonna make a bunch of money, okay? And that money that we're gonna make didn't involve any risk except for interest rate risk and time risk. But the time risk is irrelevant because the bonds are so liquid, you can pretty much sell them anytime you want. And this right here is when you want to sell them, when the interest rates go down and the price goes up. Okay, let's get back to it. This is where I bring it all home, folks. This is the aha moment. We changed one thing where our money went first. It's now in a specially designed and engineered whole life insurance policy, which is this right here. That's my policy. I'm the third year in. My cash value on that policy after putting $30,000 in for 3 years is $87,970. The year-over-year cash value growth is $30,896. So just follow me here. I put 30 in, the policy grew by $30,896. You understand what I'm saying? I made $896 in the third year, which is effectively 2.99%. So remember, it cost me 5% to borrow money, but I'm only making 2.99. So I'm negative there, right? Why am I negative? If I die tomorrow, my family gets $893,000 and some change. That has a cost. In 3 years, I was a negative run. Not negative, I made 2.99, but I didn't make more than 5. But it's okay because I have to give to get, but I got a death benefit the whole time. Fourth year, I put 30 grand in. My cash value is $119,686. So if I want to figure out year over year growth, I take the fourth year's cash value minus the third year's cash value. That's how we do it. It's always the current year minus the prior year. That's how you get the growth. $31,716, which means I made, after putting 30 in, I take $31,716 minus the $30,000, I made $1,716. This is simple mathematics, folks. If I then take the $1,716 I made, divided into the $30,000 I put in, I made 5.7%. Drum roll, please. How much does it cost for me to borrow money? 5. How much did I make? 5.7. I'm in the money, baby. Money. Let's keep going. Fifth year, I got $152,714 minus the $119,686 I had the year before. I got $33,028. I made $3,028. If I take the $3,028 divided into the $30,000, I made 10%. Oh, and Dave Ramsey, if you just happen to be watching this, you always say that the cash value doesn't get included in the death benefit, which you're right. But the death benefit has gone up. Look at this. Because the way we design them, Dave, you don't understand. But because we put so much money into paid up additions, that increases the death benefit. Look at third year, I had $893,000 in death benefit. Fourth year, $956,000. Fifth year, if I go, I got $1,017,000 that goes to my family. Now, I don't want that to happen, but if it does, isn't it better to know what's going up? Heck yeah. Why is that another factor? Remember, each year, I'm not leaving this money in the policy. I'm taking that money out and I'm making it go to work. So remember, that's what we're doing. So here, third year, I take year 3, I take $10,000 out and I move it into that treasury bond portfolio like we talked about. And my effective annual yield as of today, October 30th, is 5.24%. So you can see here, now I'm making a spread. Remember the circle, but I'm gonna take the interest from that, and I'm gonna put it back into the policy as a loan repayment. So what does that do? It pays the balance down.
Check this out, dude.
Just look at the spreadsheet here. You see, first year, I had a $10,000 loan from the policy at 5%, but my bonds produced 5.24%, which is 524%, column E. But that reduced my balance to $9,476, column G. If I go all the way over to column O over here, that shows how much interest I paid to the insurance company because I'm not paying interest on $10,000, I'm paying it on $9,476. But some of you already do this with all the loans you have out there to the traditional bank. So you are doing the same thing except one difference here. I'm the bank here. So that $524 in interest that I paid back to the policy, guess what? I have $524 more to use when that money goes in. Now, yes, I know it's going to pay the interest at the end of the year, but the insurance company only charges me interest one time a year, not every month like most loans. So I get to use my money for an entire year before the insurance company dings me any interest that they're gonna want back. But during that time, I had liquidity of that money. You'd never get that with a traditional bank. So hold on. Now let's go over here to column O. Just take a look at column O. So my effective interest that I give to the insurance company is, yes, 5%, but it's 5% on $9,476, column G, which means really I only paid 4.74. The next year, if I do the same thing, it's 4.48, then 4.21, then 3.95. What's the effective yield I'm making? What's my spread? Take column O in any of those years. We'll just do year one in this scenario, 4.74, and subtract that from 5.24. Is that more than 24 basis points? Ding, ding, ding. Aha. Do you now understand the importance and the power of how this works? Our money never stops working for us, ever. But we send our money out to work for us a second time because, heck, if the insurance company is going to pay us interest and dividends on all the money and still let us use it, but only charge us 5%, I'm making money twice, here and here. But I keep making more money every single year. Why? Because I'm taking the interest I earn on the opportunity, the treasury bonds in this case, risk, basically guaranteed by the full faith and credit of the United States government. I don't think I can call it guaranteed, but it's guaranteed by the credit of the United States, which they're not going to default because they got the Fed in their back pocket, printing presses in their back pocket. You get my point? We take that interest, we just put it back in the policy every single year. Well, every time you get it, you just put it back to the policy. But remember here, I'm 2.99 on the policy in year 3, but year 4, I'm 5.7. Spread 1. Remember, this is spread 1. But then we take the 524 minus the effective interest that you're paying to the insurance company, shown right here on this sheet, 4.74. Do you see how I'm making money twice? But you see, I make money twice and I get a raise every year. Look at the next year, it's only 4.48. If my bonds continue to pay me 5.24, did I not make more than I did the year before? Yes. And then over on the policy, the next year, I made 10%. Spread number 1. 10 minus 5, if we did it that way, yes, I made more money and both keep going up. Folks, you didn't find the fountain of youth here, but you certainly found the fountain of the wealthy and how money continuously multiplies without you having to work harder, longer, or in this case, take on any additional risk. I hope you've enjoyed this. This has been an epiphany for me. This is definitely something I'm doing immediately. And this is definitely something you should talk to your professionals about because I don't think this opportunity will exist in the future because it hasn't existed in the past. This is what now, what's next, get to work. Hey, if you liked this video, check this one out. The truth about bonds. See you next time.